Hey everyone, it's Kevin O'Leary here, Mr. Wonderful from Shark Tank, the guy who's built real wealth by always putting protection first and never letting emotions drive my investments. Today, I'm speaking directly to you retirees and near retirees, folks in your 50s, 60s, and beyond who've worked hard to build a nest egg and now need it to last through whatever 2026 throws at us. If your portfolio isn't anchored in truly safe, income-generating ETFs right now, listen closely. You could be exposing yourself to unnecessary losses in an uncertain year ahead. I've watched it happen too many times on Shark Tank. Smart, experienced people thinking their growth-heavy investments will keep delivering forever, only to get hit hard when volatility spikes or markets correct. They didn't prioritize safety, and it cost them sleep and money they couldn't afford to lose. Heading into 2026, the warnings are clear. AI-driven valuations are stretched. Vanguard calls it hot. Valuations with growing risks. Inflation remains sticky above 2%. Fed policy could surprise, and geopolitical tensions aren't easing. Goldman Sachs and JP Morgan both highlight how these factors could amp up volatility, while forecasts show gold potentially surging toward $5,000 an ounce as a safe haven play because of all this uncertainty. The issue is chasing higher yields or staying too heavy in growth stocks feels comfortable when markets are calm. It feels like you're keeping up. But that's precisely what makes it risky for retirees. You don't have decades to recover from big drawdowns. In uncertain times like 2026, with potential swings from policy shifts and global fragmentation, the wrong ETFs can erode your principal just when you need steady income the most. I'm giving you this blunt advice because I've been through multiple cycles and learned that retirees win by protecting capital first. In 2026, if you're not in the safest ETFs, ones focused on quality dividends, low volatility, and real hedges, you risk watching your retirement funds shrink instead of providing the reliable paycheck you deserve. Most people overlook these signals, thinking, I'll be fine, or the market always comes back. But from my experience turning down risky deals on Shark Tank, waiting for a correction to act is too late for retirees. Picture yourself at retirement age. You've got a comfortable savings built up, but a chunk is in volatile growth funds because everyone's talking AI or high-yield plays. Then uncertainty hits, volatility rises as forecasted, and suddenly your portfolio drops 15 to 20%, forcing you to cut spending or sell low. That's not the retirement you planned. The wealthy retirees I know don't gamble like that. They build with defense in mind. In this video, I'm sharing my straightforward picks for the 4 safest ETFs every retiree should consider for 2026 uncertainty. I'll explain why they're built to deliver steady income and lower risk, backed by what's happening in the real economy, from dividend aristocrats holding strong to gold as a proven hedge. And I'll show you how to think like the truly wealthy to make your money last. If you're watching this, you're likely feeling that concern, worried about outliving your savings, afraid of market swings eating into your income, or scared that inflation and volatility could derail your plans. I understand. I've advised countless people in your position. But stay with me, because these 4 ETFs could help you sleep better through whatever 2026 brings. Now, let's dive deeper into why 2026 could be particularly challenging for retirees without the right ETFs anchoring their portfolios. I'm basing this on the latest outlooks from Vanguard, Goldman Sachs, and JP Morgan, reports that came out just in the last month or so as we started 2026. They're all constructive on growth overall, but they're flashing clear warnings about elevated risks that hit retirees hardest: volatility from hot valuations, persistent inflation, and geopolitical uncertainty. Reason number 1, stretched valuations and AI-driven concentration creating volatility risks. Vanguard's 2026 outlook calls it AI exuberance, with potential economic upside but clear stock market downside if the massive capex doesn't deliver broad productivity gains fast enough. Tech-heavy growth has dominated returns lately, but Goldman Sachs notes that hot valuations combined with sturdy growth could lead to increased swings, exactly when retirees can least afford big drawdowns. If AI spending slows or disappoints, the market's heavy concentration in a few names could amplify corrections. Reason number 2, sticky inflation, and limited Fed room to maneuver. Vanguard expects U.S. inflation to stay somewhat persistent, hovering above 2% through 2026 due to fiscal tailwinds, tariffs, and demographics. That means the Fed has less scope for aggressive cuts, perhaps only modest easing if growth holds. Goldman highlights policy uncertainty as a volatility driver, especially with fiscal deficits and trade shifts lingering. For retirees, this erodes purchasing power quietly but steadily, making pure growth bets risky and underscoring the need for income that can keep pace. And here's the part most retirees miss: geopolitical tensions, acting as a wildcard amplifier. Goldman Sachs points to ongoing U.S.-China rivalry over AI and trade, plus conflicts in Ukraine and the Middle East, as key factors in global fragmentation. These aren't going away. They disrupt energy prices, supply chains, and sentiment overnight. J.P. Morgan is so convinced of sustained uncertainty that they're forecasting gold averaging over $5,000 an ounce by Q4 2026, driven by central bank demand and safe haven flows. When institutions rush to gold like that, it's a signal that traditional portfolios need real hedges. We've seen cycles like this play out before. On Shark Tank, I've rejected pitch after pitch where founders bet everything on growth without income buffers or downside protection. One retiree-aged entrepreneur came in with a heavy tech portfolio, bragging about recent gains, no dividends, no bonds. I warned him, volatility doesn't care about past performance. Sure enough, corrections hit, and he had to sell low to cover living expenses. Before every volatile stretch, like Post.com or 2008, people thought, this time the rally lasts forever. That overconfidence is when retirees get hurt most. Forced into sequence of returns risk, right, when they start withdrawing. Real data backs this up. Vanguard warns of growing risks amid AI exuberance. Goldman says tensions with hot valuations may increase volatility. And with inflation projected to linger, retirees relying on fixed withdrawals could see their plans derailed. But I'm not here just to highlight problems. I've got solutions. Next, I'll reveal my 4 safest ETF picks for 2026. Proven funds focused on quality dividends, low volatility, gold hedging, and bond stability that prioritize income and capital preservation for retirees like you. So what should retirees do to navigate this uncertainty in 2026 instead of staying exposed to unnecessary risks? My approach, Kevin O'Leary's approach, has always been crystal clear. Protect your capital first, generate reliable income, and let steady compounding do the heavy lifting. I'm not selling you get-rich-quick schemes, because those don't exist for retirees. You can't afford big losses when you're drawing down your nest egg. Instead, think like the truly wealthy retirees. We prioritize defense, quality, and sleep-at-night stability. First, avoid overloading on growth-heavy or high-volatility funds that could amplify drawdowns. Don't chase the remaining AI tailwinds if it means concentrated tech exposure. Vanguard warns that AI exuberance carries downside if broad productivity gains don't materialize quickly. Don't ignore sticky inflation eroding fixed withdrawals or geopolitical wildcards that Goldman Sachs flags as volatility amplifiers. Second, focus on ETFs that deliver consistent income, lower volatility, and real hedges, proven performers that have held up through past cycles. Here are my 4 safest ETF picks specifically for retirees facing uncertainty, the ones I'd allocate to in my own portfolio for protection and income. ETF number 1, Schwab U.S. Dividend Equity ETF, SCHD, the king of quality dividend payers. This fund holds about 100 high-quality companies with strong histories of paying and growing dividends. It's heavily weighted towards stable sectors like consumer staples, healthcare, and financials, not overhyped tech. With a solid yield around 3.5 to 4% and a rock-bottom expense ratio, SCHD has consistently provided reliable income and outperformed in volatile periods. It's a cornerstone for retirees needing cash flow without selling shares. ETF number 2, iShares MSCI USA Min Vol Factor ETF, USMV, your low volatility shield. This ETF systematically selects U.S. stocks with historically lower price swings, reducing portfolio drawdowns while still capturing decent upside. It's earned high ratings for defensive performance and is perfect for smoothing the ride. When Goldman predicts increased volatility from hot valuations, retirees love it because it helps avoid those stomach-churning drops that force panicked selling. ETF number 3, SPDR Gold Shares. GLD, or iShares Gold Trust, IU. The ultimate crisis hedge. Gold isn't just shiny metal, it's proven protection. With JP Morgan forecasting gold averaging over $5,000 per ounce by Q4 2026, driven by central bank buying and safe haven demand amid uncertainty, these low-cost gold ETFs give you easy exposure without storage hassles. Allocate 5 to 10% here to hedge inflation and volatility spikes. ETF number 4, Vanguard Intermediate Term Bond ETF, bond, or similar high-quality bond ETF, your income and ballast. With potential for modest Fed easing but sticky inflation, intermediate bonds offer attractive yields and diversification. Focus on investment-grade corporates and treasuries for stability. These act as the seatbelt when equities wobble. The wealthy retirees don't guess market directions. We diversify across quality dividends, low-vol plays, gold hedges, and bonds. Aim for something like 40 to 50% in dividend/low-vol equities, 10 to 15% gold, and the rest in bonds. This setup generates income, reduces risk, and positions you to outlast uncertainty. I've seen too many near retirees on Shark Tank get burned by aggressive portfolios with no income buffers. Don't let that be you. Ignore these protections, and 2026 volatility could force lifestyle cuts. But apply this safe ETF strategy, and you'll have reliable income and peace of mind. If you want more straight-talk guidance like this to secure your retirement, subscribe now and turn on notifications. We'll tackle 2026 together, the smart way. Thanks for watching to the end. I'm Kevin O'Leary, Mr. Wonderful, and I'll see you in the next video. Before I wrap this up, let me share the one mindset shift that has made all the difference in my own wealth-building journey, and the same one that separates wealthy retirees from those who struggle. I got truly rich when I finally understood this simple rule. Your money has to work harder than you do, and it has to do so safely. Early on, I chased hot deals and growth at all costs. But after seeing too many Shark Tank pitchers and too many friends lose everything in corrections, I changed. For retirees, this means shifting from how much can I make to how much can I keep and how reliably can it pay me. The truly wealthy don't swing for home runs in retirement. We build portfolios that generate consistent income, preserve principal, and let compounding handle growth quietly in the background. That's why the 4 ETFs I just shared, SCHD for quality dividends, USMV for lower volatility, GLD or IU for the gold hedge, and a solid bond ETF like bond, are so powerful together. They're not exciting, they won't make you the talk of the golf club with massive short-term gains, but they're designed to give you predictable cash flow and protection when uncertainty hits, exactly what you need in 2026 and beyond. Let me quickly recap the safe allocation I'd recommend for most retirees facing today's environment. 40 to 50% in SCHD or similar high-quality dividend ETFs, your reliable paycheck replacement. 20 to 30% in USMV or minimum volatility strategies to reduce the stomach-churning drops. 10 to 15% in gold ETFs, GLD/IU. Your insurance policy against inflation and crisis volatility, especially with forecasts pointing toward $5,000 plus gold this year. The balance in intermediate bond ETFs or treasuries, your ballast and dry powder. Adjust based on your risk tolerance and income needs, but always keep protection first. Rebalance once or twice a year, collect the dividends, and let time do the rest. I've turned down countless deals on Shark Tank that looked brilliant on paper but had no margin of safety. The same principle applies to retirement investing. Brilliance without safety is just gambling with money you can't afford to lose. If you take nothing else from this video, remember this. In uncertain times like 2026, the goal isn't to beat the market, it's to outlast it with your lifestyle intact. Apply these 4 safest ETFs and the Protect First mindset, and you'll be far ahead of most retirees who are still chasing yesterday's winners. If you found this helpful and want more straightforward, No BS guidance on building and protecting retirement wealth, especially as we navigate whatever 2026 brings. Hit that subscribe button right now and turn on notifications. I'll keep delivering the kind of advice I wish someone had given me decades ago. Thank you for watching all the way through. I appreciate you trusting me with your time. I'm Kevin O'Leary, Mr. Wonderful, and I'll see you in the next one. Stay safe out there and protect that capital.